Welcome to the Deep Dive. We're the show that cuts through the noise, really unpacks complex info, and pulls out the key insights. The goal, to get you well-informed fast. Today, we are diving deep into financial performance, specifically the future outlook for a company everyone knows, Netflix.
Yeah, and our main source here is a pretty detailed analysis of Netflix earnings and future outlook. It's got the specific quarterly numbers, revenue, market comparisons, even projections aimed at investors, so it's quite comprehensive.
Exactly. And look, this isn't just reciting numbers. It's about what they mean. What do they tell us about the company's health, the industry? What's next? What does it really mean when a company beats or misses expectations? And how can understanding that give you an edge in watching the market? Let's unpack it. So, okay, let's start with the latest numbers. Netflix's quarterly earnings for June 2025. What did they report?
All right, so the key figure is earnings per share, or EPS. They reported $7.19 per share, and that beat the Zacks consensus estimate, which was $7.07 per share.
Okay, so a beat. How does that compare to last year?
Good question. A year ago, they were at $4.88 per share, so quite a jump. This latest number represents an earnings surprise of positive 1.70%.
And wasn't the previous quarter also a beat? I feel like there's a bit of a pattern emerging.
You're right. The quarter before this one, they reported $6.61 per share when the expectation was $5.69. That was a plus 16.17% surprise. Pretty significant.
Wow.
And actually, if you look back over the last 4 quarters, they've surpassed the consensus EPS estimates every single time. 4 for 4.
Okay, so consistent beats on earnings. That sounds strong. What about the other side of the coin revenue? They posted, $11.08 billion for the quarter ending June 2025.
That's right, $11.08 billion. Now, this is where it gets a little more nuanced. While that number is up from $9.56 billion a year ago, so, growth is there.
Right.
But it actually missed the Zacks consensus estimate, only slightly, mind you, by 0.06%.
Ah, okay. So not a huge miss, but still technically a miss.
Exactly. And unlike the consistent earnings beats, they've only topped revenue estimates twice in the last 4 quarters.
So, okay, listener, you've got this picture. Strong earnings beat, slight revenue miss. What does that mix usually signal for the stock right away?
Yeah, that's always the tricky part, isn't it? With mixed signals like these. Well, the immediate price movement, how the stock reacts right after the report, it often really hinges on what management says during the earnings call.
The commentary.
Precisely. Their explanations, their context, and crucially, their guidance for future quarters. Yeah. That's what investors latch onto to figure out the real story behind the numbers.
Makes sense. Context is everything. And speaking of stock movement, we should probably mention Netflix's performance this year. It's been pretty remarkable, right?
Oh, absolutely. Year to date, the shares have gained something like 40.3%.
40%. Compared to the S&P 500's gain of, 6.5%?
Yeah, just 6.5% for the S&P. So Netflix is significantly outperforming the broader market.
Okay, so strong past performance. But investors always want to know what's next. How do they gauge that?
Well, a really reliable measure investors look at is the earnings outlook. This involves looking at the current consensus earnings expectations for the coming quarters and, importantly, how those expectations have been changing recently.
Right, the trend in expectations, and I know there's research on this.
Yeah.
Something about estimate revisions being predictive.
Exactly. Empirical research shows a strong link between near-term stock movements and these trends in earnings estimate revisions.
Why is that? Why are those revisions so powerful?
Think of it as the collective wisdom, or at least the collective shift in wisdom, of analysts. When you see analysts who study these companies day in and day out start raising their forecasts together or lowering them, it signals a change in the fundamental outlook.
Mm-hmm.
And that change in expectation often comes before the stock price itself moves significantly. Investors can track this stuff themselves or use tools like the Zacks rank, for example, which is specifically built to harness this power of estimate revisions.
And for Netflix, what was the trend leading up to this report?
Interestingly, the estimate revisions trend for Netflix was actually favorable before this earnings release, signaling some positive momentum.
Okay, so favorable revisions trend, strong recent performance, a decent earnings report with that slight revenue miss. Boiling it all down, what's the verdict for Netflix's immediate future?
Well, based on all that, particularly the revision trends, Netflix currently holds a Zacks rank #2.
Which means?
That's a buy rating. It suggests the shares are expected to outperform the market in the near term.
Got it. And do we have the actual consensus estimates for what's expected next?
We do. For the coming quarter, the consensus is looking for $6.56 in EPS on about $11.29 billion in revenues. And for the full current fiscal year, the numbers are around $25.45 for EPS and $44.55 billion in revenue. That's the current expectation baked in.
Okay. So the company's specific picture seems pretty positive overall, but you mentioned earlier companies don't exist in a bubble. What about the industry context?
Right, that's a crucial layer. Even a star performer can face headwinds if its industry is struggling. The outlook for the whole sector, in this case the broadcast radio and television industry, can definitely impact stock performance.
And where does that industry stand right now, according to the Zacks rankings?
It's actually in the bottom 35% of the over 250 industries that Zacks tracks.
Bottom 35%.
It's not great.
No, it's not ideal. And our research consistently finds that the top 50% of Zacks ranked industries tend to outperform the bottom 50% by a factor of more than 2 to 1.
Wow, 2 to 1.
Yeah. So it definitely raises a question. How does a company like Netflix, with strong fundamentals, navigate being in a potentially weaker industry group? Does its strength win out, or does the industry drag hold it back somewhat?
That's a really interesting tension. Maybe a comparison would help. Is there another company in that same industry we can look at?
Yes, good idea. Let's take SiriusXM, stock ticker SIRI. They're in the same broadcast radio and television industry, and their results for the same quarter, ending June 2025, are actually expected soon, around July 31st. Okay, so what are the expectations for SiriusXM? How do they compare?
Well, it's quite a different picture. For SiriusXM, analysts expect quarterly earnings of $0.78 per share. But here's the thing. That would actually be a decrease year over year, down 2.5%.
A decline, okay.
Yes. And adding to that, the consensus EPS estimate for them has actually been revised down by 1.8% over the last 30 days. So analysts are getting a bit more pessimistic.
And revenue?
Revenue is also expected to be down. The forecast is $2.13 billion, which is a drop of 2.1% compared to the same quarter last year.
Wow, okay, that really throws the Netflix situation into sharp relief, doesn't it? You have Netflix beating earnings, mostly positive signals, great stock run, and then SiriusXM in the same industry facing expected declines and downward revisions.
Exactly. It highlights that while the industry context matters, it provides headwinds or tailwinds, individual company execution, their specific strategy, and how investors perceive their future growth prospects reflected in those estimate revisions are still incredibly important drivers.
So wrapping this up then, what's the main takeaway?
I think it's that you need both perspectives. Individual company performance is obviously key, those earnings beats, the guidance, but you absolutely cannot ignore the broader industry health and, crucially, those shifting investor expectations captured by things like estimate revisions. They are really powerful forces shaping a stock's path.
Right. So here's a final thought for you, our listener, to chew on. If a company like Netflix perhaps consistently beats earnings expectations, but it's operating in an industry that might be facing some real challenges, how does that dynamic play out long term? What does that tell you about where to look for sustainable growth and maybe where your next big insight might come from? Something to think about.